Hey, Joseph with Power Capital Solutions. And listen, I want to make a video for my real estate investors who are utilizing their credit in order to get unsecured funding so they can get into more deals, flip more properties, and acquire more buy and holds. So here's the deal. If you are a real estate investor like myself and you don't have an extra amount of money just laying around for gap funding or down payment or rehab funds, or even to make the requirements for the cash reserves that a lot of hard money lenders are going to require, this video is for you. So unsecured funding, once again, in some of my other previous videos, I've spoken about how it's different from traditional financing or a hard money loan in which there's no collateral. There is no lien placed on the property. There's no lien placed on a car or art or any kind of 401k account. No collateral whatsoever. Is fully unsecured. But here's the deal. The way that qualification works is predicated on your income and or your credit profile. So a lot of times when it comes to credit, hard money lenders are not as strict because they have an asset that they're going to give you a loan against. So in the event, even if your credit or your repayment history isn't that great, in the event you were to default on that loan or you stop making payments, they can always seize that property as collateral and they can still recoup some of that loss. When it comes to unsecured funding, there is no option to do that. Therefore, they have to ensure you have strong credit and or income. But I want to focus exclusively on credit right now. So you got to understand that when it comes to credit, your credit report is comprised of 5 main things lenders look at, especially when it comes to unsecured funding. So without further ado, I'm going to go ahead and get into the first one, which is your payment history. Your payment history is extremely important. Your payment history encompasses 35% of your overall credit profile. So you have to understand your payment history is crucial. And the more recent you've had a late payment, the bigger impact it's going to have on your credit profile. So please make sure you pay people on time. And if you are going to be late, anything beyond 30 days is going to reflect on your credit report. So make sure you make those on-time payments. Second thing I want to cover, credit utilization ratio, aka CUR, whatever you want to call it. Pretty much, how much do you owe? If you have a credit card with a $10,000 limit and you owe $9,950, you're basically maxed out. And in that case, your credit utilization ratio is going to be 99%. I don't have a calculator handy, but that's basically 99% credit utilization ratio. Now, I want to let you know, most lenders, when it comes to the unsecured funding space, typically they do not want to see any utilization above the 50% threshold. Ideally, you want to keep your utilization ratio at 30% or lower, never ever above, and definitely not at 50% or higher. So that encompasses 30% of your overall credit report. So you want to ensure that whatever balances you have, you get those as low as possible. The third component of your credit profile is going to be the length of your credit history. So oftentimes it's a little bit more challenging for younger people to go and get a car loan or get a mortgage because you haven't had that length of credit history to prove to multiple lenders, hey, I can pay money back. So if your credit profile only has maybe 1, 2, maybe 3 trade lines that are active and they've only been active for 6 months or a year, oftentimes that's going to give you a lower score as well. And once again, that encompasses 15% of your overall profile. So you want to ensure that if you have the ability to do so, you open up accounts, you make sure that you're responsible for making on-time payments, and you let those accounts season That way you have a more lengthy credit history when the time comes for you to pull the trigger and actually apply for funding. Next is going to be diversity of your accounts. So diversity of your accounts is going to comprise 10% of your overall credit profile. And simply all that means is, what type of mixture do you have as far as auto loans, a mortgage? Do you have unsecured loans? Do you have secured loans? Do you have revolving lines of credit, aka credit cards, or traditional lines of credit in which you only pay interest and balance based off of what you use and then you pay it back? These things are very important. Banks want to see that you're able to manage and handle different kinds of credit and pay them back and keep the balances low at the same time. So diversity of accounts, that's going to be the fourth component. And then lastly, new credit or hard inquiries, that makes up the remaining 10% of your overall credit profile. So whenever you apply for funding and the lender sees that you recently applied, or you recently opened up a new account and got a new credit card, let's say 2 months ago, that can hurt your chances of getting funded in that moment. And if it isn't new credit, hard inquiries is also a huge pitfall that hurts a lot of investors who are trying to apply in order to get some unsecured funding. Normally, anything beyond 6 inquiries in the past 6 months will have a lender automatically deny you. Not always, that's not a hard rule, but typically 6 inquiries in the past 6 months or more is going to make it really challenging for you to get funding. So please make sure, if you are going to apply for any kind of funding in the near future, ensure it's funding that you're pretty confident you can get funded. And if not, maybe do some other things such as paying down some of your balances. That way you can get your credit utilization a lot lower. So once again, just to enumerate all of those components I just listed, first and foremost, your payment history, 35% of your credit report. Credit utilization ratio, 30%. Credit history, 15%. Diversity of accounts, 10%. And then lastly, new credit and hard inquiries is going to be the remaining 10%. Those are your 5 components. And listen, I cannot reiterate this enough. Credit score is not indicative of how quality your credit profile is. I mean, it's indicative to a certain extent, but you have to understand, a person who has a 690 credit score can get more funding than a person with a 790 or 800 based upon those 5 components I just listed for you. You can have a person who has a 690, but they have 20 years in credit history. They have a car loan, a few mortgages, a handful of credit cards and lines of credit and unsecured loans, and they pay back their money in a timely manner, and they have an excellent payment history spanning over decades. And then on the other hand, you have a person with an 800 credit score, and let's just say they only have maybe 2 or 3 established trade lines, and they've only been active for maybe 2 years. They have great payment history, but other than that, they don't really have much else to show. A lender's going to want to take a bigger chance on a person with a more robust profile, with more diversity, and they can actually look at the trends, look at the patterns, and be able to determine, how's this person going to pay me my money back? So hopefully that makes sense. If you are a real estate investor and you already have your hard money taken care of, you already have or working with the lender who's already giving you a great deal on a rental acquisition, but maybe you just need the funds to rehab or get the down payment assistance, our firm provides unsecured funding for real estate investors. Please make sure you click the link below this video. Go ahead and apply. We do not do any hard inquiries just to get pre-approved, and we can figure out what your funding projection would be within the next 24 hours. So definitely do that. And if you have any scenarios or you have any general questions, be sure to email me at joseph@powercapitalsolution.com. Happy investing.